Hello, everybody, and welcome to another video by the Option School. Today, we will be talking about short strangle option strategy. This is a part of our Let's Talk option strategy, and this is your friend Pradeep Singla. Very happy to go ahead with the strategy number three. You must have seen our previous two videos. In first video, we talked about iron condor option strategy. Then in second video, we talked about short straddle, and then very popular strategy known as short strangle option strategy. We'll talk about various parameters of this short strangle option strategy in today's video. Now, again, this is a two-leg strategy. Both the legs are of selling. Both call and put are involved. We all know this. So, what is the difference between short strangle and short straddle? Short straddle was covered in the previous video. If you have not seen, please go ahead and see that also. So, in this case, you are selling out of the money put and out of the money call, whereas in short straddle, we were selling generally at the money call, at the money put. Even if you're not selling at the money call and put, you're selling call and put which are of the same strike price. But in short strangle, they are not of the same strike price, they are of different strike price. And again, this strategy is having a limited profit, but yes, definitely unlimited loss, but probability of profit is really good. In the end of the video, I will be asking very interesting question and also making some good announcement. So please stick to the video till the end. Now, when to do again when the trader expects the market to be range bound. So most of the option selling strategies expect the market to be range bound so that whatever you have sold, there will be a decay in the premium and ultimately you buy it cheaper and sold at higher price, purchased at lower price means you're booking a profit. But this is a very popular strategy because when we are trading in short straddle, there is a range fixed by whatever premium we are getting. But in short strangle, we have an advantage that okay, we can decide what should be the range within which we think the market is not going to break, or within which the market is going to fluctuate. So if short straddle was confined to maybe the premium, so it can be 700, 800 points kind of a width only. In this case, we can have 1000 points width, we can have 1500 points width. I will show you some examples also. So this is a slightly better strategy because you have much more control over what kind of width you can see in the market, which is not there in short straddle. And another feature of this strategy is this strategy is very popular with intraday traders. What happens? Options are decaying assets. So every day we expect okay there will be some decay in option prices, which is known as theta. So if market doesn't make a very wild move in any direction after it has opened, if it has opened gap up, gap down, that is no issue for intraday traders. Once it has opened, let us say gap up by 100 points, and after that it stays within 50 to 100 points, you definitely see some amount of decay in the option strangle, right? So what generally they do, right in the beginning, after initial settlement of 5-10 minutes, they will sell a strangle, and anytime they are getting a decent profit in that during the day because of decay, they will square it off, and that is how most of the intraday trades are done in short strangle. There are obviously some adjustment methods also in case market moves here and there. So you need to deploy some adjustment methods also. So knowing adjustment methods, whether you are doing it as a positional trade or whether you are doing it as an intraday trade, knowing adjustment methods is really important in this strategy also because it's an unlimited loss strategy. So what is the margin required? Another advantage, yes, we do require lesser margin compared to short straddle, but again, margin is to some extent dependent on the width of the trade. Depending upon if the width is high or width is low, accordingly the margin will be decided. But generally, what we have seen, if you're doing a monthly trade or if you're doing a positional trade, margin in Nifty is in the range of 90,000 to 1 lakh rupees for short strangle. And similarly, as we have shown in our short straddle video, there also you can use the same method to reduce the margin required. So in this case, another advantage is in case of short straddle, we have seen that the margin required gets reduced by 30 to 35,000. But in this case, out of 1 lakh, margin can get again reduced by 45,000. So generally, we have seen the overall margin requirement gets reduced by almost 45 to 50%. So that is again a bigger advantage in short strangle. I will show you both the examples. One is with reduced margin and one is with uh, uh, complete margin, right? Now, break even points, how many break even points in any option trading strategy? We must know how many break even points are there. So, obviously, in this also, because you're selling a call, you're selling a put, there is a upper break even point, there is a lower break even point. If market remains within these break even points till expiry, trade will be profitable. But bigger catch is that if market doesn't move much, every day the trade will start giving you some profit, some profit, some profit, depending upon your risk appetite, depending upon your target profits. You can decide that okay, this is the day, maybe 4 days after the trade, maybe 10 days after the trade, I am comfortable booking my profit, not necessary at all to sit in the trade till end. And obviously, in case market breaks any of the break even points, trade can go into a decent loss. Remember, this is a unlimited loss strategy, so you should be very very cautious, okay, when to take the trade and when to book the profit. And what kind of profits are expected? Again, profit of 3 to 5% can be expected on monthly basis. Many traders say that okay, we do not want to do monthly trades in short triangle. We want to do weekly trades. So they try to make something like 1 to 1.5% profits on weekly basis also. So there is a chance that okay, if you are an intraday trader, then also maybe half a percent profit or 0.3% kind of a profit on day to day basis you can make. And there can be some days where you can get really stuck up, so you need to be very experienced if you want to do purely intraday. If you want to do weekly, yes, 1 to 1.5% is quite possible. There can be 1 week out of many weeks wherein there can be some big swing, and these profits can be spoiled. There can be a loss also, but for that you need to know a lot of adjustments. Now, profit versus loss ratio should be kept as 1 is to 1. So if you're doing a monthly trade, you're expecting that okay, I will make 5% profit, you should always be ready for 3 to 4% loss also. So 1 is to 1 means whatever kind of profit I'm expecting, maybe that kind of loss can also happen. And so overall in a year, maybe 8 to 9 months you will book profit. 2 to 3 months there can be loss also, but again, the strategy can be good enough for 35 to 40% returns in a year, especially in stable markets. But only for those traders who know that okay, when to get out of the trade. You cannot remain in the trade till expiry. Never ever wait in this trade till expiry. Even if you're doing a weekly trade, or even if you're doing a intraday trade, it's always better that okay, by 2:30 or by 2:45, either you have some stop losses in place or you close the trade with whatever little or more profit you have got, right? So this doing a short strangle, whether we are doing it for a very short period, whether we are doing it for a slightly longer period, it's like sitting on a seat of thorns, right? So first opportunity you get to remove your trade by booking profit, you should definitely avail that, because it's an unlimited loss kind of a strategy. So any big swing in the market tends to give loss, at least on the shorter term basis. On a longer term basis, let us say you're trading on a monthly strategy, then yes, even if there is a negative m2m on a short term basis, but over a period of time, if market remains within that range, this can be a highly profitable strategy also, because decay is pretty fast in short strangle compared to short straddle also, right? So if I give you an example, this in this example, what I have done, I have taken a monthly trade. So what we have done, we have sold 18,950 call. There is a purpose why we have selected this call. So we are following a particular delta in this, and we have sold 17,750 put. So overall, what we have done, we have received 8,122. And if you see, the margin required is 94,000 rupees. So roughly around 8.62% profit is possible if market remains within those break-even points. In fact, if market remains within 750 to 950, which is a decent 1200 points, then you will get this profit. Otherwise, your break even points are slightly wider, because whatever uh, credit we have taken by selling both call and put, so that gets subtracted on the put side, that gets added on the call side, right? So pretty decent range, 17,588, or you can say 17,600 to 19,100 is around 1,500 points range. And it's not that okay, you should be sitting in the trade till end. Anytime you're getting, let us say, 2%, 3%, 2,000 rupees, 3,000 rupees, sometimes it happens that okay, you get this 2 3,000 rupees right in the beginning of the month, then does make sense to close this, and maybe based on market condition you can make a new short strangle also, right? Again, short strangle is a Vega negative strategy, so it is advisable that okay, when VIX is slightly higher, at that point in time, if you create a short strangle and scare it off when VIX has gone down, then there's a double benefit. You are getting a theta benefit also, you are getting a Vega benefit also. But when volatility is low, short strangle may not be a very advisable strategy, right? So margin used in this case is around 95K, right? So 1% profit means 950 rupees, 2% profit means 1900 rupees, and 5% profit means 4750. So we are good enough for 8% profit. Out of that, even if you get one third of that, which is around 2.8 to 3% profit, which will be roughly 3000 rupees, it's a good trade. And generally it is seen that okay, market may not make a very wild swing if market is range bound within, let us say, 200 points, 300 points on the upside, so it goes up to 18,500, goes down up to 18,000. This is a pretty safe trade. Only in case market starts making wild moves of 700, 800 points on each direction, then most of the other strategies also require that okay, you do adjustment, and this strategy also will require that we need to do an adjustment. Now in case I'm saying I'm taking a margin benefit, don't see at the payoff diagram, what here we have done, we have taken the same trade for easier understanding, the same short strangle. But what we have done, we have purchased 19,200 call in just 2 rupees 45 paisa. Remember, the sold positions are monthly positions, purchase positions are weekly positions, so that the rates are very low. So we have just spent 2 rupees 45 paisa and 2 rupees 80, around 5 rupees we have spent. And by spending this 5 rupees, we have purchased weekly protections. So what has happened is, out of 95,000, now my margin required is only 55,000. So almost 40,000 rupees out of 95,000 rupees got reduced, which is a big relief. Don't go by these numbers, because these numbers will show that okay, this will be the profit on 1st December. So as I always say, always better buy these protections, but do not keep this protection in the Obstra chart. Remove that, and you know that okay, you have spent 55,000 only, and profits will be dependent on 55,000. So if it is 55,000, even if you make let us say 1,500 rupees, that is pretty much 3%, and which can come pretty fast in these kind of trades if conditions are good. But yes, definitely when VIX is slightly low, this may not be a very good strategy. Now another thing is that okay, this is a short strangle with margin benefit. If I show you a short strangle, this is a short strangle with monthly selling. Let me show you another short triangle in which what we have done is we have done a weekly setting. And all of you who have already subscribed to the channel, you know what to do. Please click on the like button. And all of you who are new to the channel and you want to learn all these basics of all the strategies, we will be covering 15 to 16 strategies in this series. Please go ahead and click on the subscribe button and then click on the like button. Now, here in this slide, what we have done, we have taken a weekly short strangle. Now, what we have done for 1st December, we have sold 18,550 call and 18,050 put. So, total we have received 3348, which is 3% of the margin required. In this case, this trade has a range from 17,984 to 18,616. Now, in this case, you see the margin required is 106. In the previous case, when we had done a monthly short strangle, the margin required was 95,000. In this case, is 1,06,000. And on weekly basis, it can give me 3%. Even if I say one third of this is 1% on weekly basis, which is pretty good. Or even if I say 50% of that, that means when the decay happens, 50% of the premium decays, I will close the position. Then also I'm good for 1.5%. So this is on weekly basis. Now there is a very interesting question. If you are going through this video carefully, you see what has happened on weekly basis. When I'm creating a short strangle, I am required to pay a margin of 1,06,000. When the same short when I was making a short strangle for monthly basis, it was requiring I'm talking about without margin benefit. It was requiring a margin of roughly around 95,000. So weekly is becoming costlier and monthly is cheaper. So that is the very interesting aspect of this. And I'll ask you a question on this only. Uh, and how was the performance of short strangle in the previous month? So if you want to know the performance, what we are doing, we are publishing the performance of previous months. So for October month, we will be publishing the performance in a day or two in our strategy members group. So performance of short straddle and iron condor is already published. This can be accessed through the playlist. There is a separate playlist for strategy members group, and only those people who are members of those strategy member group can see these videos. So performance of short straddle and iron condor is already published. We will be very soon publishing performance of short strangle also. And when the month changes, we will be publishing performance of all these strategies for the month of November also. So if you want to join or upgrade, if you're already a diamond member or a gold member, you can upgrade to strategy members group. Or if you're not a member, you want to join, you can straightway click on the join button and join the strategy members group. Now the question, which is very important, and I want each one of you to reply, because there is a very finer aspect of understanding short strangles which is involved in this question. And if you are able to answer it, even if it is wrong, don't mind that, right? Even whatever is your first thought process, top of the mind answer, you should write it in the comment section, because that will make things much more clearer to you. Why weekly short strangle is asking for more margin compared to monthly short strangle? As I have shown you, weekly short strangle, we are requiring a margin of 1,06,000. Monthly short strangle, we are requiring a margin of 95,000. So there is a difference of 11,000 rupees. So my question is, why a weekly trade is requiring more margin, a monthly trade is requiring less margin? There is a very fine aspect of margin calculations which is involved in the answer. I know most of you know, but whether you can express it, uh, write it in the comment section immediately, and we will definitely try to give reply to each and every comment, so that thought process is very clear. Answering some questions or asking some questions definitely make things much more clearer to you, right? And our inner circle mentoring group too, we are beginning our second ICMG group. It is starting in December first week, and we had done a webinar on this, and many of you registered in the webinar, but because of some reasons could not attend the full webinar, or was able to attend a very small portion of webinar. So we are getting many requests that, okay, can you share the webinar, can you conduct another webinar for this? So if you, in case you miss the webinar, you, what you can do is you can WhatsApp your Gmail ID to us. Number is shown on the screen, 9999700956. What we will do, we will share the webinar with you for next one day, for next 24 hours. We will share that webinar with you, and after 24 hours, we will remove the webinar. Now, this, what is this inner circle mentoring group? All the questions are answered in that webinar. But broadly, I will say this mentoring activity will go on for next 6 months. More than 23, 24 live sessions will be there. Plus, lot of material will be shared with all the members, and group size will be kept very small. But it will be suitable in case you have more than 15 lakhs of capital. Then you will be able to do full justice with this mentoring group, because then you will be able to deploy your money to different strategies, right? So anybody who is interested, who is serious in making money, in this webinar, we have shown some of the feedback or views of our ICMG group one also, which is already running. So if you are keen, you want to see this, you can WhatsApp your Gmail ID uh, to this number, and we will be sharing this webinar with you for next one day. For more content on option strategies, check out our the Option School app. There are many free videos. There are many paid seminars also on that. So you can just go through those things, and a lot of announcements we keep on making on our app. So go ahead and uh, download the app. Link for both iOS and Android is given in the description. Thanks for watching, and see you in the next video. And if you have not seen our previous video of short straddle and iron condor, I am leaving the links for that here, and you can go through those videos. Thank you. Goodbye.